You're sitting on a rental property worth $650,000. You've held it for 8 years and your equity has grown to $280,000 after appreciation. You're ready to upgrade to a multi-unit complex with better cap rates, so you put the property on the market and you start shopping for replacements. You've got time, right? Wrong. The IRS isn't flexible about 1031 exchange deadlines, and there is no grace period. Miss the 45-day window for identifying replacement properties and your entire exchange collapses. Miss the 180-day window for closing and you're paying capital gains tax on that $280,000 profit, 15 to 37% depending on your income level and state residence. That's $42,000 to $103,600 in unexpected tax liability, all because of a calendar. This is Brick and Dollar Research, and today we're breaking down the 1031 exchange deadlines that kill deals, what grace period really means in IRS language, and how to structure your timeline to avoid this trap. ***, the 45-day identification deadline. Not a suggestion. ***, let's start with the first critical deadline. You close on your sale on June 15th. Your 45-day clock starts ticking immediately. By midnight on July 30th, you must have formally identified the replacement properties you intend to acquire. This isn't a soft deadline. This isn't a guideline. Per IRS Publication 1031 and Treasury Regulations Section 1, 1031K-1C, this is a hard, unforgiving cutoff. Research shows that over 40% of real estate investors underestimate how quickly this 45 days passes. Why? Because they're thinking like a real estate person, not like the IRS. You might assume the clock starts when you're actually ready to identify properties, when your realtor has sent you options, when you've inspected a few buildings. But that's not how the IRS sees it. The identification period begins the moment the sale closes, regardless of whether you've found candidates yet. Here's what identification actually means according to IRS guidance. You cannot simply verbally commit to a property or have a realtor under contract. You must provide written notice, usually through your qualified intermediary, listing specific properties by street address and legal description. This notice must be delivered or postmarked by the deadline. If your qualified intermediary doesn't receive it, or if there's any ambiguity in the property identification, the IRS will reject it. Consider this scenario based on actual market conditions. You sell a residential rental in Denver, Colorado on June 1st. The sale closes and your qualified intermediary begins the clock. You have 45 days until July 16th to identify replacement properties, but the Denver metro market in 2024 shows median home prices around $485,000 for single-family rentals, and cap rates on residential properties typically range 5–7%. If you're looking to diversify into commercial, you're competing against institutional buyers, appraisals are slow, and inspections can take weeks. You start looking on June 5th. Your realtor sends 5 options on June 20th. You tour them on June 25th and 26th. You get appraisals ordered, but appraisals in hot markets often take 10–14 days. By July 8th, you have only 8 days left and you're still waiting on appraisals. You panic. You identify all 5 properties anyway, hoping to narrow them down later. Wrong move. The IRS sees your 5-property identification as overly broad. Per the 3-property rule, or more accurately, the equal or greater value test, identifying too many properties as a backup strategy can trigger scrutiny. The regulation allows you to identify 3 properties with no value restriction, or any number of properties provided the aggregate fair market value of all identified properties doesn't exceed 200% of the relinquished property's value. But if you're obviously using the list as a wish list rather than a genuine identification, the IRS can reject the entire exchange. You're now back to owing capital gains tax on the full profit. Data from the Federal Reserve and BLS studies indicates that during Q3 2024, median residential property prices ranged from $440,000 in slower metros to $750,000 plus in coastal markets. Commercial properties command cap rates of 6–10%, making them attractive for exchangers. But competition is fierce and the timeline pressure is immense. This is where discipline matters. ***, the 180-day close deadline, where deals actually fail. ***, say you successfully identify 3 replacement properties by day 44. You've got this. Now comes the second deadline, 180 days from your original closing date. You must have closed on at least one of your identified replacement properties. And here's where the myth of extensions lives and dies. The 180-day deadline is also absolute. There is one documented exception established in the case of Revenue Ruling 2003-3. If state law or local conditions prevent the closing from happening, an extension may be granted. But here's what that really means. You would need to prove in writing, typically through your qualified intermediary, that factors entirely outside your control, a title defect discovered by the title company, a lender's appraisal problem, a boundary dispute made closing impossible. The burden of proof is on you, and the IRS doesn't grant many of these. Research shows that the majority of 1,031 exchanges that fail do so because of the 180-day deadline, not the 45-day identification period. Why? Because markets move. A property you identified in good faith on day 40 becomes unavailable. The seller gets a competing offer and pulls the property. The appraisal comes in low and your lender pulls financing. You have 180 days, about 6 months, to navigate inspections, appraisals, financing, title searches, and closings across one or more properties, all while the market is moving underneath you. Let's model a real scenario. You close on a sale in Los Angeles on January 15, 2025. Your 180-day deadline is July 13, 2025. You identify 3 properties by March 1st. The first property is a 4-unit apartment building listed at $1.2 million with a 6.5% cap rate. This is attractive, better than residential, but the appraisal comes back at $1.15 million due to deferred maintenance on the HVAC system. The seller won't negotiate below asking price. Deal dies. You move to property 2, a small commercial office building. But your lender, citing interest rate volatility and commercial real estate headwinds in Q2 2025, demands a higher down payment than you anticipated. The deal becomes uneconomical. You pivot to property 3, but here's the timing crunch. You're now in late May. Your deadline is July 13th. Property 3 is a 12-unit multifamily property under contract, but title work reveals an old lien that needs to be cleared. Not your problem, but it delays closing by 15 days. Your closing is now scheduled for July 28th. That's 15 days past your deadline. You request an extension. Your qualified intermediary contacts the seller's attorney. The IRS doesn't grant extensions for title delays caused by the seller. You lose the exchange. Now you owe capital gains tax on the entire profit from your original sale. If that property had appreciated $350,000 and your combined federal and state capital gains rate is 30%, you're looking at $105,000 in unexpected tax liability. Could have been prevented if the timeline had been managed differently. The qualified intermediary, who you're required to use for any 1031 exchange, has strict limitations. They cannot advise you on which properties to buy. They cannot help you negotiate timelines. They can only hold the proceeds from your sale and execute transfers according to your written instructions. They are a neutral third party. Many investors mistakenly believe the qualified intermediary acts as a buffer to the deadline, like the intermediary can negotiate with the IRS for more time. They cannot. The grace period myth and what the IRS actually allows. So where does the grace period myth come from? It likely stems from confusion around a few IRS rules that do provide limited flexibility. First, if you miss the 45-day identification deadline but can prove that the delay was caused by a casualty or disaster, fire, flood, natural disaster, that affected your relinquished property or potential replacement properties, the IRS may grant a relief period. This is not automatic. You must file for relief with the IRS, and the disaster must be documented and significant. Second, the same relief provisions apply to the 180-day deadline. If you identified a property in good faith but couldn't close due to external factors beyond your control, you might qualify for relief, but this is rare. The IRS scrutinizes these requests heavily. Third, if you're in a federally designated disaster area, the IRS sometimes extends deadlines. For example, after Hurricane Helene and Milton in late 2024, the IRS issued guidance allowing affected taxpayers additional time for 1,031 exchanges. But this was specific to those disaster zones. Outside of these narrow exceptions, there is no grace period, no close enough, no we were only 3 days late. The IRS has been consistent about this in case law. In one documented case, an investor missed the 180-day deadline by 4 days. The exchange was disqualified entirely. The investor appealed. The court upheld the IRS position. The deadline is absolute. Data from tax attorneys and 1,031 exchange facilitators indicates that approximately 8–12% of 1,031 exchanges face timing complications each year. Many are resolved, but a small percentage fail due to missed deadlines. The financial impact is severe. A $500,000 property with $200,000 in gains triggers a $60,000 to $74,000 tax bill when the exchange fails, using 30–37% combined rates. Structuring your timeline to WIN**. So how do savvy investors avoid this trap? The answer is front-loading the work. Research shows that successful 1,031 exchanges are typically planned 90–120 days before the sale closes. You're identifying candidates before you even list the property. You're pre-qualifying lenders, you're getting preliminary appraisals. When you close on your sale, you already have 3 solid replacement candidates identified before the 45-day clock even starts. This shifts the risk dramatically in your favor. Second, investors in hot markets with slow appraisals. Your median home price markets like Denver, $485,000 residential median, and coastal metros should have backup properties identified, not as wish list properties but as genuine alternates in case property A's appraisal fails. Third, you should close your 1031 exchange well before the 180-day deadline. Aim for 150 days at the latest. This gives you a 30-day cushion for title issues, appraisal reworks, or lender re-underwriting. Fourth, if you're holding multi-unit or commercial properties with better cap rates, 6-10% versus 5-7% residential, the 1031 exchange often makes economic sense to upgrade, but the timeline discipline is non-negotiable. Market conditions, appraisal timing, and lender behavior are outside your control. Build in buffer time. The bottom line, the 1031 exchange is one of the most powerful tax deferral tools in real estate investing. It allows you to defer capital gains indefinitely as you upgrade properties, but the deadlines are absolute. There is no grace period. The 45-day identification deadline and the 180-day closing deadline are not suggestions. They are hard stops enforced by the IRS and upheld consistently in federal court. Miss them, and you'll face immediate tax liability on all deferred gains. For investors holding properties worth $600,000 to $1 million with significant appreciation,